Welcome back. Now, according to fresh data from the Central Bank of Nigeria, external reserves climbed to $41 billion as of August 19th, 2025. Now, that's up by more than $4.5 billion, or about 12% year on year, compared to the $36.47 billion recorded in August last year. Now, the last time reserves were this strong was back in March 2021, when they stood at $41.08 billion. The CBN says stronger reserves give it more capacity to defend the Naira. At the close of trading on Thursday, the Naira appreciated slightly, gaining 95 kobo against the US dollar. The currency closed at 1,535 Naira, 78 kobo per dollar, compared to 1,536 Naira, 73 kobo the previous day. Joining us now from our Lagos studio to make sense of all of this is the MD, that's Managing Director, CEO, Financial Derivatives Company Limited, Bismark Rewane. Thank you so much for joining us this evening.
Thank you for having me.
Great. Well, now let's take a look at what factors have driven Nigeria's external reserves to a 4-year high of $41 billion.
Well, there are many factors that go into determining what the level of reserves are. But first of all, let our viewers know the difference between gross reserves and net reserves. Gross reserves includes obligations that have not been met and so on. When you compare reserves of countries, you actually look at net reserves. So Nigeria's gross reserves have actually increased sharply from a level of $32.91 billion in August last year to over $41 billion, up about $7 billion. I think that has to be clearly understood. Secondly, the level of external debt that Nigeria had actually increased also from 42.5 to $46 billion. So whilst the reserves increased by $7 billion, the debt also increased by $4 billion. So net, Nigeria is in a better place by $3 billion. And the debt that we acquired, the $2 billion diaspora bonds, $2 billion and general bonds that were issued, Euro bonds that were issued. So let us break it down and try to understand why your reserves will increase if what you've exported is more than what you imported. And therefore, your payments, you can see those slides showing very clearly. You can see very clearly there that our external reserves in August, gross external reserves in August last year were 36. That's what you see in the left-hand corner. And it has gone all the way to 41.05, a remarkable achievement by the central bank. You will see that by August last year, the currency, the stability of the currency, the convergence of the currency, the gap between the parallel market and the official market had closed dramatically. And so when you look at the next slide, you will see that Nigeria posted a balance of trade surplus, more or less, of $6.83 billion in 2024, reversing the deficits of 2023 and 2022. The goods that we exported increased by 63% to $13.17 billion, driven by higher gas, and non-oil exports went up by 36%, and gas exports also went up. But on the other side of it, you'll find that our imports, what we imported, fell by 16%. So why are our imports falling? Our imports are falling because the Naira is more expensive, and that is the benefit of the convergence of rates and removal of the rent in the exchange rate. What Nigeria is facing today, Nigeria is witnessing what we call a managed floating exchange rate, being efficiently and effectively managed by the central bank. That we must understand. Foreign portfolio investments came in and went up by $13 billion, and that has helped to support the currency. And you see that clearly. You'll find that, that has kept the currency in play. $13 billion of this. But the problem with foreign portfolio investments is it is hot money and it can go away. What happened in Southeast Asia in the 1990s happened during the hot money era of 2008 and 2009 has put us on notice that we cannot depend on hot money. What you read is the foreign direct investments. But in any case, the foreign portfolio investors are taking advantage of, one, our high interest rates and our stable currency. So that's what we call the carry trade. They are benefiting from it, and it's not a bad thing for now. At least it has brought about stability in the exchange rate. And one thing you must note is that when the exchange rate is stable and appreciating, it helps to actually moderate inflationary pressures. And when inflation maintaining a downward trend, which you can see, you will see that the country begins to become attractive to investors, both portfolio and foreign direct investors, and local investors for that matter. And it also, there's a risk of capital flight. So what you are seeing now is peer group comparison. You will find that a country like Nigeria, total net reserves is $22 billion and gross reserves are 46. Our net reserves are half of our gross reserves, right? And also our net reserves is only half of our total external debt. Go next to South Africa. South Africa has $60 billion of net reserves, but has $173 billion of debt, external debt. Therefore, for every $1 of reserves they have $3 of debt, which is it's a leveraged position. If you go to Ghana, it even gets worse. Ghana has $4 billion of net reserves and $28 billion of debt, which means that for every dollar of reserves that Ghana has, it has $7 of debt. That's a very leveraged and fragile position. If you go to Kenya, Kenya has $11 billion of net reserves and $41 billion of debt. That means for every dollar that Kenya has in reserves, they have $4 of debt. So Nigeria is in a good position in the sense that Nigeria, for every dollar of net reserves, we have $2 of debt. So Nigeria is less leveraged and less vulnerable to exogenous shocks. So, and what this means really is that Nigeria's external position is not as fragile as painted. Nigeria's external position, and you know that Moody's and Standard & Poor's have all said the outlook is positive, and that is, we are looking at it from a monetary policy perspective. So they've been able to manage this effectively, but there's still signs of fragility in the sense that if you take out the $13 billion of foreign portfolio investments, which will not go at once, but it could go, it means that your reserves will drop from $41 billion, right, to maybe about $26 or $27 billion, right? But it still gives you cover. Right now, Nigeria's gross reserves gives you about almost 10 months of cover, import cover. And the IMF says that a country that has less than 6 months of cover is the one that you watch. But if Nigeria already has 8 to 10 months of cover, it means that it's in what they call the comfort zone. And therefore, investors are not going to be worried. Our traders and those who buy our instruments are not going to be worried. Why has this happened? 1, exports have increased. 2, imports have reduced because the exchange rate is more aligned to its fair value. And another thing that you must notice is that the Dangote refinery has helped in terms of reducing our import bill, and also he has been able to export fertilizers, getting about $3 billion a year, more than what we get from cocoa, and has also gone a long way to actually export some refined products across the Western and Central Africa. So those are the factors. 1, imports have dropped. 2, exports have increased. 3, the Dangote effect on actually diversifying the exports. And 4, gas and cocoa have helped to stabilize our external position. So Nigeria's external position is in a very good place at this point in time.
Well, in as much as we really should applaud the level that we are at the moment, how sustainable is this growth in reserves going forward? Can we, can we sustain this in the long run?
No, it's quite fragile. That's why I said if you take the foreign portfolio investments out, you will find that the situation is not as great as it might look. But even if you take that out, we are still having cover of about 6 to 7 months, which is definitely within the comfort zone of the IMF. So is it sustainable? Yes, it is sustainable, but not for too long. So what we need to do is to ensure, one, that we bring inflation and price stability to a moderating level where we are beginning to see that now. Two, we reduce the amount of debt that we are trying to pile up, except for specific projects. And three, the fiscal authorities must begin to address the question of leakages out of the system. There are leakages, and leakages have a negative multiplier effect. So policies are one thing, programs are the other, projects, and then followed by impact. That is what you need to see.
Oh, great. Now, to what extent can stronger reserves also help to defend the Naira effectively?
I don't think the question of defending the Naira is an issue. The Naira, you only defend the Naira when it's under speculative attack. Right now, is the Naira aligned with its fair value? We think that the Naira is probably about 24% undervalued, depending on what parameters you use. If you use the PPP, it should be about 1,200. If you use the hamburger index, it's much more. It's more overvalued than undervalued. But generally speaking, what we must watch are two things. One is the difference between the parallel market and the official price. That was as wide as 120 Naira in the past. It's now down to about 8 or 9 Naira, which is clearly what we can call a safe and sweet spot. Two is the fact that the price of oil, the doomsday scenario is when it drops to about 60 or below 60. Right now we're at about 65, 68. And the point of fiscal neutrality, where the break-even point is about 70. But what is more important is that our production, which was about 1.3 million barrels a day, is now up to about 1.5. By the time you add condensates, it's about 1.7 million barrels, which means that Nigeria's profile of Nigeria's exports is such that if we continue to produce 1.5 million barrels a day, and we continue to produce as much gas as we are seeing now, and we have cocoa, we have fertilizer, we have soya bean, then first of all, the export profile is diversified, and the invisible payments in from the creative sector, from the football, entertainers, movies, and Spotify and all of that helps to give a very balanced picture. And to that extent, I don't think that there's a need to defend the currency when it is fairly aligned with its fair value. I think that's the way you look at it. So the question that Nigerians want to ask is that today the Naira is trading at about 1543 Naira, that is 1,543. The parallel is about 1540 or 1535, so it's about 8 Naira difference. What do you think the value of the Naira will be in December? We think that it will trade between 1530 and 1570 between now and December. Why do I say that? We do not expect the price of oil to drop below $60 a barrel. We expect cocoa, which is trading at about $8,000 to remain at that level, gas to remain at that level. We also expect that our production will be at about 1.5 million barrels a day. And therefore, there's what we can call a dynamic equilibrium in the economy. And to that extent, we will see the main crop harvest of cocoa in October, November. We will see oil production. There's a meeting of OPEC in next month, September 7, I think. And all things being equal, we should have a kind of a balanced position, and to that extent, we do not expect the Naira to swing and have that major devaluation like we had 2 years ago. So the benefits of an undervalued currency is that it puts everything in equilibrium, and the currency does not fall or does not witness violent swings. Having said that, We are in a world where the external vulnerabilities are very high, and the uncertainties that we'll deal with also have to be considered. The Central Bank of Nigeria has an MPC meeting coming up September next month, in about 4 weeks from today. I think they'll be watching the data. But one thing you must note is that Jerome Powell, that is the Federal Reserve Chairman, said today in Jackson Hole, in the symposium of central bank governors, he said clearly that he has left the window open for a rate cut in September. The market is expecting a huge rate cut, but I think he's going to allow a rate cut of about 25 basis points. And if the interest rates in America, the United States, drop, it means the dollar value will depreciate, and that will enhance the value of the Naira relative to the US dollar. So generally speaking, I think we are going to be gliding into December with a stable exchange rate.
All right. So, but I just want to know what you think. This slight appreciation of the Naira, does it really reflect real stability, or is it just short term? And then ahead of the CBN meeting, what do you think the specific steps the CBN needs to take to maintain and even build on these reserves? I know you talked about increasing exports and some other items that you listed earlier while you were answering some of the questions.
No, but what I said, maybe you didn't pick it up very clearly, is that the Federal Reserve Bank is having a meeting in September, and it's almost clear from what Jerome Powell said today that they're going to bring down interest rates. If U.S. interest rates come down, and the Nigerian Central Bank, we think, will probably, depending on the inflation numbers that will come on the 15th of September, 4 or 5 days before the MPC meeting, it is possible that the Central Bank of Nigeria could come down by 25 basis points to match the interest rate inflation differential, which means that the Naira will not depreciate sharply. In fact, as a matter of fact, it will probably appreciate in the circumstances in September. In October, we would have the main crop harvest for cocoa. We will have the fertilizer exports that you are seeing. We will see Dangote refinery bringing down prices and adopting uniform price across Nigeria for PMS, which will come down from a current level of 865 pump price, probably come down to about 850 at that time. So if you have inflation moderating, you have interest rate reflecting the same differential between the US drop by 25 points and ours by 25 points, there's no reason to fear that the Naira will fall violently. In any case, in December, when we have dirty December, and this year is a special, we have what we call the dirty December, the 3 Ds, we think that there will be much more inflows of dollars from our creative sector and the stability of the currency over the past 12 months. So it's, I think, from a monetary policy perspective, from a currency alignment perspective, the Naira is likely to be stable and just appreciate maybe marginally, or even it depreciates not much in the last quarter of this year.
All right, so before I let you go, let me just ask you how significant the gap between the official and parallel market rates, and what does it mean for the economy?
I addressed that earlier, and I would like you to, I'll make it very clear. Yes. The difference between the parallel and official market was over 150 Naira some 6-12 months ago. Today it's 8 Naira. So if you take 8 Naira as a percentage of 1,500, it's less than 0.5%. The IMF says that if the difference between the parallel and the official market in any market is less than 5%, then you don't worry. In this case, it is about 0.5%. So definitely the Naira trading range now is a sweet spot, and therefore people can go to sleep without speculating against the currency. If things change rapidly and there was some unexpected shock, then we begin to look at it. But at this point in time, we do not expect any unexpected shocks, and we think that things will be stable from now towards the end of the till the end of the year.
All right, well, clearly put now. Thank you so much for your time on the Rise Exchange, Managing Director, CEO, Financial Derivatives Company Limited, Bismark Rewane. Thank you very much.